We can't begin any discussion of corporate finance without a solid review and understanding of financial statements, a company's presentation of its operating results over a recent time period, and its financial condition at some specific point in time. As we proceed through this course in finance, we will focus on, and our concern will be with, a company's economic results and financial condition. Keep in mind, those may differ from the accounting results recorded in a company's formal financial statements, which are meant to be a representation of the economic results and creating data that is useful to managers and investors for making decisions. In this discussion, when I talk about a company's economic results and condition, I generally use terms like resources, obligations, and market value of equity or market capitalization. These are meant to be in contrast to standard accounting terms you might be familiar with, like assets, liabilities, and the book value of equity. Similarly, I often use cash flow or economic returns as the finance alternative to the accounting terms revenue, expenses, profit, or net income. To facilitate this discussion, try to keep a picture in your mind of a company as a real-world organism, not as some ephemeral entity existing only on some accountant's documents. When we recognize a company as a real-world organism, we can then contrast its economic results with the accounting representation of those results. Double entry accounting, developed in and used since probably even before the 15th century, is based on the definitional equality that a company's assets are equal to its liabilities and owner's equity. Since accounting is meant to be a representation of the real world, let's look at the real world counterparts to this equation. We start with the company's resources, what it owns and uses to produce its products or offer its services. These include liquid resources like cash, work in process, and finished inventory, amounts collected from its collectible from their customers. But primarily it includes longer-term investment in productive resources, especially tangible items like plant and equipment or land. But a company, especially today, also has great value invested in many intangibles, things like brand recognition, their product or service reputation, human capital, the accumulated knowledge and learnings of its employees, maybe even relations with labor unions. Another big intangible is patents. Sometimes they're developed directly by a company and other times purchased in a monetary transaction. Everything that makes it possible for the company to produce its products or provide its services, and importantly, to collect the price it commands for that product or service, counts as an economic resource. Of course, as hopefully you recall from your accounting studies, not every resource is recognized by the accountants as an asset. This is a topic we'll come back to later when we discuss the balance sheet specifically. A company may also have certain obligations that it has promised to certain parties or has contracted to meet. We can easily identify some of these items, like the amount a company owes to its employees for the work they have completed, or bills that it must pay to its vendors for materials or services they supplied. Obligations also include amounts the company has borrowed from its banks, bonds it has issued to investors, or leases it has entered into. Bank debt, leases, and bonds are all contracts between the company and its lenders, laying out the specific obligation the company has to repay the amount provided and any interest on that amount. If the company defaults on those contracts, the lenders may have rights to the company resources over the rights of the owners. Companies, and a few governments, have also made huge financial promises to employees to provide them with retirement income in the form of defined benefit pensions or retirees' health care. These obligations used to be missing from an accounting balance sheet, but have recently been incorporated, causing much consternation and apparent deterioration in a company's financial position. Of course, the real economic financial position didn't change at all. The obligation was always there. The accounting rules just didn't require firms to record it. Even now, the financial amount recorded is an estimate that may seriously understate or overstate the actual obligation. What other obligations might a company have that the accountants haven't recorded? Legal claims by workers, customers, or vendors? Environmental obligations? These are potential economic obligations, not generally recognized by a firm's accountants and therefore not showing up in the financial statements. When you own a business or are a shareholder in a corporation, you are entitled to the residual assets and cash flow. That means you have a claim on any remaining value from liquidating the resources and paying all the outstanding obligations. Similarly, in any shorter period, shareholders are entitled to the cash flow generated after meeting all the firm's interim obligations, such as wages, debt interest, and lease payments. In the balance sheet context, then, the equity is the difference between the company's resources, their assets, and their obligations, the liabilities. In a market value sense, it means the shareholders receive the increase in economic value, or the economic returns from the assets, net of any increase in obligations. If the value, the market prices of the assets increase, it predominantly means an increase in the market value, the market capitalization of the equity. But in double entry accounting, the system of debits and credits arising from the accounting equality, remember, assets defined to be equal to liabilities and equity, means that the equity will always be equal to the difference by definition. This means that if the accountants do not record certain resources as assets or obligations as liabilities, or understate the value of certain assets or liabilities, then book value of owner's equity must also be misstated. In fact, in their textbook, Emery, Finnerty, and Stowe from 2007, the authors claim that book value of the firm's equity is probably the least informative item on a balance sheet. Owner's equity arises in two ways: from an accounting standpoint as well as an economic value standpoint. Any monies invested directly by the owners in the company in a distinct transaction, such as when forming the corporation or when contributing additional capital, whether from existing owners or from new owners, such as in an IPO, is called capital stock. However, when the company generates excess cash flow, and does not pay it out to the owners in the form of a dividend or a share repurchase, the result is also an increase in the owner's investment in the company. It is as if the cash flow was paid out to the owners, since they are entitled to it, And they immediately turned around and purchased new interest, shares in the company. Of course, no real transaction occurs between the company and the owners. And in fact, management is generally the party that makes the decision to retain those earnings. To be clear, the accountants record any profits, right, that accounting term, not cash flow, as retained earnings, but the concept is the same. It's as if the investors reinvested those profits into the business. As I mentioned, retained earnings increase by the amount of any resources generated by the company and reinvested in the business. This is how companies grow organically and is the primary source of new capital for most businesses. The two components of changes to retained earnings in an accounting context are profits, which increase retained earnings, and dividends, which decrease retained earnings. Profits, also called net income, arise directly from the income statement each period. Whatever the bottom line is for that period becomes part of retained earnings in what the accountants call a closing entry. If management decides to pay any dividends to the shareholders, then the dividends are recorded as a reduction in retained earnings. Let's dive into now the formal accounting financial statements produced by companies for the benefit of investors and for management. There are generally 6 parts to a firm's financial statements. 4 statements of data, the notes to those financial statements, and an outside party's report on their review of the firm's internal controls and conformity to GAAP, or generally accepted accounting principles. Publicly traded corporations are required to submit their audited financial statements to the SEC every year in what is known as a 10-K filing. The 10-K includes additional regulatory information about the company and about its securities, but will include the financial statements always as item number 8. Another important and interesting section of the 10-K is item 7, management's discussion and analysis of financial condition and results of operations. That's a mouthful. We usually just call that the MD&A. This is where management will discuss about what is reported in the financial statements. Companies also often produce an annual report, which is not to be confused with the financial statements or the 10-K. Annual reports used to be nice, glossy, printed brochures, but today they are generally only produced electronically in HTML or PDF formats. The annual report will have a lot of nice pictures of employees and customers enjoying their relationship with the company and may have pretty pictures of the company's products. It will also likely include a letter from the chairman of the board or the president or both to the shareholders describing what a wonderful company it is in which they have invested. All of that is nice, but it's generally fluff. The company will usually include the financial statements in the back of the annual report, but it will almost never include the MD&A. So for the most complete picture of a company's condition and results, get the 10-K. You can generally access a company's financial statements on their website, investor relations page. Try typing in the name of the company's website and /investor. Most of the time, that URL will take you to the correct page. If not, look at the bottom of the home page for something like About Us or Corporate Information. Once there, look for a link to annual reports or financial information, and you should find a PDF or an HTML version of the annual report. Occasionally, this company will simply provide a link to the 10-K, which is, of course, fine. A very reliable but slightly more time-consuming way to access the 10K is through the SEC's database of corporate filings called EDGAR. Look for the link to search for company filings and then search by company name or stock ticker. You may have to search the list of company names for the parent company to bring up a long list of filings. Companies are required to make a lot of regulatory filings. Depending upon the screen you come up with, because the SEC has just recently updated EDGAR, it might be simpler under the search screen for document type, input 10-K, and then research. That will bring up all of the company's annual filings in reverse chronological order. Select the most recent listing and confirm it is for the time period in which you are interested. My last visit to the EDGAR website, they had redone it, and there was actually a button that pointed to annual filings. So that could make this process much easier for you. Once you have the actual 10K report, remember that the financial statements and notes are always item 8, and the MD&A is item 7 within the 10K. The balance sheet flows directly from that accounting equality that assets are defined to be equal to liabilities plus owner's equity. And that's how the balance sheet is organized. Conceptually, the assets are listed on the left-hand side, and then liabilities are on the top of the right-hand side with equity detailed below on the right-hand side. In practice, when printed, a balance sheet generally has the assets listed first on the top with a total assets line indicating the sum of all the asset categories. Below that, the liabilities are listed with a total liabilities line. Owner's equity is at the bottom with a total equity line. Then the liabilities and equity sections are summed in a line labeled total liabilities and owner's equity. Of course, this line must equal the line for total assets. That's what we mean by balance. A balance sheet, which may also be called a statement of position, is always as of a specific day of the year, the last day of the reporting period. In that sense, a balance sheet is a snapshot of the company's resources and obligations, as well as the difference between them. This snapshot treatment means companies can at times engage in window dressing the balance sheet for that specific day, such as by keeping a higher cash balance or shipping a lot of products right at the end of the year to minimize inventory. The balance sheet will also separate assets into a current assets section, meaning those assets expected to be turned into cash within 1 year, and then a non-current or long-term assets section. Similarly, liabilities are broken into a current liabilities section and then listing long-term liability accounts. Both current account sections will have a subtotal line. Be very careful when looking at a balance sheet not to confuse the current asset subtotal when you are looking for the total assets figure. The balance sheet presentation will generally show the account balances for the end of the current fiscal year and the one previous. This allows for a simple comparison between the beginning of the year, the end of the last fiscal year, and the end of the current year. At a glance, you can see if the company's assets have been growing and which accounts in particular. You can see if there's been a significant change in the liabilities from one period to the next. And finally, how has owner's equity changed? An increase in equity likely means that the company has done well, but a decrease does not necessarily mean something bad. It may just be that the company paid a large dividend or repurchased a large amount of its shares. Remember that GAAP prescribes what resources are recorded as assets and at what value they are recorded. Generally, this means only resources that have been purchased in a monetary transaction, and the value is the historical cost of that transaction. Many, many resources are not ever recorded on the balance sheet, such as brand recognition, company reputation, or the quality of the workforce. And assets that do make it to the balance sheet are not typically recorded at their market value, which would reflect what the company would realize today if they sold the asset. Take a look at the McDonald's Corp balance sheet someday and see what the accountants record as the value of the McDonald's brand. 0. But most of us would agree that the brand and McDonald's reputation for consistency, quality, and cleanliness may be the most valuable asset that McDonald's has. Likewise, the balance sheet may not include all of a company's obligations, since only those that are known and can be accurately estimated monetarily qualify as a liability. Companies may disclose in the footnotes that they are parties to certain lawsuits that may give rise to a monetary judgment or settlement, but they can't definitively determine the amount, so a liability is not recorded. Similarly, a company, especially an industrial manufacturer, may be causing some unknown environmental damage and will ultimately bear the costs of cleanup or remediation. But as of today, that obligation can't be recorded because of the uncertainty. Think about the BP oil spill in the Gulf of Mexico. As soon as the Deep Horizon well failed, BP had a large obligation for cleanup and recorded a liability. But the day before the spill, the company had the same obligation to clean up any potential disaster. The obligation didn't suddenly arise the day of the accident. So if some resources are not recorded as assets, and some assets are misvalued, and some obligations are unknown, how accurate can the accountants measure of the difference between assets and liabilities really be? What the accountants call book value of equity bears little to no relationship to the market value of the company or the company's stock price. Let's take a look at the big tech titans of today's economy, known as the FANG stocks: Facebook, Apple, Amazon, Netflix, and Google. This chart shows a comparison of the book value of equity, the very small blue bars, to their market capitalization, the quite a bit larger black bars. This is the market value of their shareholders' equity. While the differences here are extreme, looking at almost any company's book value of equity versus its market value of equity will show these large discrepancies. For the FANG stocks in particular, but again, the concept applies to almost all companies today, intangible assets, generally not recorded on the balance sheet, have become larger and larger percentages of a company's economic value. Today, in the U.S., intangibles are estimated to represent over 70% of the market capitalization, of the market value of equity of most companies. And that's up from the mid 40%, really probably only a decade ago. Most managers are familiar with the income statement, since the items on the income statement are those items we are often called upon to forecast in the budgeting process, such as sales, which turn into revenue, or costs, expenses. Of course, as we'll see in a minute, what ultimately gets recorded as revenue for any period or gets deducted as an expense in the period may vary greatly from what we think of as a sale or a cost. The income statement is also referred to the P&L for profit and loss, or is listed as the statement of earnings or statement of operations. When the word consolidated appears in the title, it just means that you're looking at results for the whole company or all the subsidiaries in a corporate group. The income statement measures a company's results over a period of time, specifically the period between the dates on the balance sheet. So while the balance sheet is a snapshot, the income statement is a flow measure. Compare the difference between your bank account, a snapshot of how much of your salary you have saved at any point in time, and the amount of your salary, how much will flow into that bank account over a certain period, be it 2 weeks or a year. An income statement is structured to show revenues first, the top line, and then subtract out various forms of expenses to arrive at net income or profit, the bottom line. We'll see in a minute what that structure actually looks like. Historically, there's been a tension between producing a useful and accurate income statement versus a useful and accurate balance sheet. Recent changes in GAAP standards to return some meaningfulness to the balance sheet mean companies now show a short extra statement after the income statement called the Statement of Comprehensive Income. Do not confuse this Statement of Comprehensive Income with the income statement. It generally starts with net income, the bottom line from the income statement, and then shows other, often very technical and obtuse additions to or subtractions from the retained earnings account on the balance sheet that aren't considered part of income for the period. At this level, don't pay much attention to this statement of comprehensive income. Just don't mistake it for the income statement. Now, as with the balance sheet, GAAP prescribes when cash receipts are recorded as revenue or sales, and when cash payments are recorded as expenses. In a nutshell, remember that in any interim period, cash in does not equal revenue, and cash out does not equal expenses. So profit does not equal cash in minus cash out. I can still recall my graduate accounting professor repeatedly saying, over a sufficiently long enough time period, profit will equal cash in less cash out. But that is definitively true only over a very long time frame, perhaps only the entire life of the business. Revenue recognition, that is when sales are recorded and in what amount, is an accounting process that is based on many assumptions and estimates. And for many companies, bears only a passing relationship to cash received from customers. Revenues then are offset by expenses, the costs incurred in generating those specific revenues, regardless of when the cash was paid for those costs. The end result is that the income statement, based on a multitude of assumptions, estimates, and frankly sometimes wild guesses, presents a very technical picture of the operating results for the company. This does not mean it is wrong in any sense. It just means you have to be very aware of what goes into the numbers on the income statement and understand the discretion and biases that can be present. This is where the tension I mentioned earlier between the income statement and the balance sheet comes into play. Historically, accounting standards worked on the assumption that there was a primacy to reported earnings, in that operating results should be the focus of management and investors, rather than the ending wealth, the net resources or net assets of the business. The income statement reports operating results over a specified time period and ideally shows some representation of what business results are repeatable in the future for the business, if economic and industry conditions remain roughly consistent. Since most business strategies center on selling goods and services and producing them cost effectively, rather than building up stores of economic value, conceptually the income statement is a better reflection of how management achieved its objectives inherent in that strategy. This accounting standards focus gave rise to accrual accounting and the matching principle in GAAP, and relegated the balance sheet as a repository for the residual effects of those accounting estimates, rather than a real measure of the firm's economic resources. The income statement follows the very basic structure of revenue minus expenses equals net income. But it would be a very small and very simple company that actually presented their results in that simple format. Instead, companies structure the income statement to show various levels of profitability. That is, deducting certain types of expenses consecutively from revenue. The expanded income statement always shows revenue or sales, you can use those terms interchangeably, as the top line. Some companies may deduct some small amount, like for returns, and then show a line that is net sales. Very occasionally, a company may show revenue from 2 or more lines of business or products, and then a total revenue line. From revenue, the first group of expenses deducted are costs of goods sold, COGS or COGS. These are the expenses incurred in directly producing the products sold or the services provided. This gives a measure called gross margin or gross profit and shows how much the company makes just by selling its goods and services. If a company can't show a gross profit, they can't stay in business very long because they can't generate enough cash flow to pay for operating the rest of the company. From gross margin, then, we subtract those other operating expenses, often referred to as selling, general, and administrative, SG&A expenses. This is what many of us think of as overhead, the cost that it takes to run the business day to day beyond producing our products or service. Along with SG&A, depreciation on assets not used in producing the products are deducted to arrive at perhaps the most important number on the income statement, operating income, or earnings before interest and taxes, referred to as EBIT. Why is this number important? Well, first of all, it is what many managers of a business unit or product line are judged on, since it includes only the things they can control. Second, this is the real measure of how a company's core business is doing. This is the money they earn by executing their business strategy, cost effectively producing their product or service, and maximizing the price they receive in selling that product or service. If you can't earn money by executing your strategy, you need to reevaluate the strategy. From operating income, EBIT again, then we subtract the non-operating expenses like interest paid on debt and ultimately the income taxes on earnings. Most operating managers aren't concerned with these items as they can't control the amount of debt the company employs or what its tax rate is. Companies generally also have some other minor income or expenses not related to the main business that are recorded here before arriving at net income. So while a real-world income statement may look more complex than that simple equation, revenue minus expenses equals net income, once you consider that each subsection of the income statement follows that simple equation, you can see that the complexity disappears. So now we come to the statement of cash flows, which is not to be confused with the income statement, but is produced for investors because there are so many assumptions, estimates, and smoothing of expense and revenues in the preparation of the income statement that it doesn't tell us enough about the cash flow of the organization. In fact, its use and required preparation arose out of a number of frauds and intentional misuse of income statement reporting, as well as a recognition of the limits on the practical use of the income statement, even when legitimately prepared. The key reason for its preparation is because, as I've emphasized, and will always emphasize, cash in does not equal revenue, and cash out does not equal expenses. Companies, especially growing ones, can show profitability without generating positive cash flow. And companies that are unprofitable in an accounting sense may be cash cows, throwing off prodigious amounts of positive cash flow. In the long run, a company has to generate cash flow and profits to be successful. If it can't generate positive cash flow, it can't pay its bills and will go bankrupt. If it isn't earning profits, its business strategy isn't sustainable, and it will go out of business. It is important, therefore, to consider the income statement in conjunction with the statement of cash flows. Although if push comes to shove, most investors will focus more attention on the cash-generating capability of a business than its profit-making ability. But most managers concerned with executing a strategy will focus on profits or net income. The concept behind the presentation of the statement of cash flows is quite simple. Show how much cash came into the business and how much cash left the business. Real cash based on bank accounts, not based on accounting assumptions or estimates. This makes the data very hard to manipulate to make the company's results look better or worse. When reading the statement of cash flows, remember that a source of cash is a positive number, and a use of cash is a negative number. Always. Like the income statement, the statement of cash flows presents a flow measure of results over a period of time, specifically, again, between the two dates on the balance sheet. This way, the change in cash shown on the statement of cash flows will tie out to, will agree with, the change in cash between two dates on the balance sheet. While there are technically two ways to prepare or present the statement, most companies follow a method that starts with accounting net income from the income statement and then shows all the non-cash adjustments that have been made to the income statement and the balance sheet. The real value of the cash flow statement, though, comes next. The statement of cash flows breaks the company's sources and uses of cash into three categories: operating, investing, and financing. Cash flow from operating activity measures changes in the cash related to the firm's main day-to-day activity of producing and selling its products and services. This is what the business is in business to do. For that reason, in my not so humble opinion, cash flow from operating activity is perhaps the single most important figure in the financial statements. If a company is not generating cash flow by executing its business strategy, maybe it is in the wrong business or has a bad strategy. At the very least, if a company's cash flow from operating activity is negative, it warrants a much closer look at why. Similarly, an investor will want to see operating cash flow increasing over time. And if it isn't, investigate why. In particular, pay very close attention to a situation where profits are growing faster than operating cash flow. Cash flow from investing activity measures sources and uses of cash from the acquisition or sale of the company's long-term productive assets, such as buildings, machinery, equipment, other businesses, and the like. This is where you will find what the company has spent on capital improvements to help it grow. In the ideal situation, you see a company generating positive cash flow from operating activity and then having a similar magnitude negative cash flow from investing activity, centered on the line fixed or long-term assets acquired or capital expenditures. Don't confuse the term investing here with what you might think of from personal experience. From the standpoint of the company, investing does not generally mean buying stocks and bonds or other securities. Most businesses are not in the business of investing in securities. While you might see a line for purchases of investment securities, it is usually offset by sales or maturities of the securities, which are generally very short-term in nature. Focus on what the company is really doing, which is hopefully investing in long-term tangible business assets that it will use to produce its products and services. Cash flow from financing activity shows how the company raised capital from or repaid capital to its investors. For example, did it issue any stock or borrow net new money from lenders? Did it repay some debt or pay dividends to shareholders or repurchase common stock from shareholders? If the company is growing beyond what its operating cash flow can support, allowing for necessary investments and capital improvements, then it will need to show a source of cash in cash flow from financing. It will be necessary for it to have increased the capital investors, be it lenders or owners, put into the company. On the other hand, if the business is somewhat mature, it may be throwing off more cash flow than it can reinvest profitably into the business. And it will be in a position of returning cash to its investors for them to reallocate to other businesses with more substantial growth opportunities. Unlike the income statement, though, the bottom line of the statement of cash flows isn't likely to be very helpful. In most cases, it just shows the net change in cash for the company, which again just ties to the change on the balance sheet. Since most companies try hard to keep a minimum of cash and a consistent amount from year to year. Showing how much it changes is irrelevant, especially if the definition of cash doesn't include cash equivalents like short-term investments, bank deposits, or money market funds, or commercial paper, for example. Changes in cash equivalents usually show up in the investing section if you want an idea of how much the company's liquidity improved or declined. That is not the purpose of the statement of cash flows. The purpose and value of this statement of cash flows is in looking at, analyzing, and understanding the patterns among positive and negative totals from the three sections. With three categories of cash flow, each of which can take one of two states, positive or negative, there are 8 possible patterns of cash flow results for a business. Each separate pattern can tell us something about the state of the business. This chart gives the reader a brief cheat sheet on how a company is doing based on the identified pattern. Consider pattern 2, for example, which happens to be the most common result for most mature companies in particular. Cash from operations is positive, a source of cash to the business. Cash from investing is negative, a use of cash. They're making capital investments, capital improvements, capital expenditures. Cash from financing is negative. This means the company is successfully generating cash operating the business and is using some of that cash generated to invest in more productive assets, presumably setting up the firm for continued future growth. The balance of the cash is used to pay down debt or return cash to investors. Pattern number 6 is very typical for young, growing companies. They aren't yet generating enough cash from sales to cover expenses, and they're making investments in productive assets for future growth, so they must raise cash in the form of capital raised from investors. Every company will fit into one of these 8 patterns, giving some clarity and understanding as to how the company is sourcing and using its cash, a critical indicator of how the business is doing overall. The final statement, the statement of retained earnings, is designed to show all the changes in one single balance sheet account, retained earnings, from the end of one fiscal period to the next. Most companies expand this to include the capital stock account and call it the statement of shareholders' equity. Either way, the intention is to reconcile what management has done with the resources that owners have entrusted to management. This is a fairly technical statement, doesn't get much analytical attention, so we'll pretty much ignore it from here on out. Okay, this is going to be an ugly and apparently overly detailed page, but it serves, I believe, a very useful purpose of demonstrating how the 4 financial statements work together. We begin with the beginning balance sheet. That's as of the end of the last accounting period. And the ending balance sheet, that's the end of this accounting period. The change in cash position between the 2 balance sheet dates is exactly what the statement of cash flows explains. The income statement records revenues and expenses, again, accounting terms, not cash in and cash out. Revenues and expenses occurred between the 2 balance sheet dates, producing net income for the period. Net income gets added to the amount of retained earnings from the beginning balance sheet, and if the company paid any dividends, they are subtracted from retained earnings. That activity derives ending retained earnings, which of course flows to the ending balance sheet. While they might look like it, the notes to the financial statement are not the boilerplate or the fine print at the end of the statements. Along with the MD&A, they are a critical source of information for an analysis of a company. The notes are where the company discloses all the information that supports or is summarized in the actual statements. This is where you find a description of accounting policy choices the company has used in revenue recognition, inventory flow, asset valuation, or depreciation, just to name a few. These choices and the assumptions and estimates implied by them can seriously influence the end results on the income statement in particular. The notes will also show the details behind some of the aggregated totals reported. For example, the notes will show each debt issue under which the company has borrowed, along with its maturity and interest rate, and break down its lease obligations by the years in the future when the payments are due. In the notes, the company will disclose and discuss any contingencies that don't make it onto the balance sheet, or a description of their pension and retiree health care obligations, which are often significant. In the MD&A and in the notes is where the company will break down its results by business segment or geographical location. They will discuss hedging strategies that protect the company from changes in commodity prices or currency exchange rates, and disclose the likely effect on the company from inflation. In short, there is a multitude of critical business information in the notes. Do not ignore them. The final piece of the financial statement puzzle, although it generally appears first, is the audit report. This is a letter from an independent third party, a certified public accountant or CPA, that they have been engaged by management to review and audit the company's financial statement and internal financial controls, and to express an opinion on those statements and the controls around their preparation. The CPA, which can be a firm or an individual, simply attests that the financial statements were prepared in conformity with GAAP, or not, and therefore present fairly the financial condition and operating results of the company. Notice the word fairly. The CPA does not attest to the accuracy, preciseness, or even the truthfulness of the statements, just that a user can rely on them for an understanding of how the company is doing without being misled. The responsibility for the truthfulness and accuracy of the statements falls on management. In fact, it is management that prepares and presents the financial statements, not the outside accountants, the auditors. That is why companies have such large accounting departments. It is their responsibility to collect the data and produce the information that goes into the financial statements. Of course, in practice, management often works together with the auditors to make sure their decisions regarding allowable treatment of transactions and the assumptions and estimates used in the preparation are reasonable. If the auditors concur with management decisions and the audit process finds no material discrepancies, the auditors will produce a clean or unqualified opinion. That is, their opinion that the financial statements fairly present the firm's condition and are not subject to any other conditions or disagreements with management. A Qualified opinion, on the other hand, is one in which the auditors express some problems or skepticism about management's presentation of the financial statements. Qualified opinions are very rare because management will generally acquiesce to any changes required by the auditors, knowing that a qualified opinion is likely the death knell of a business, especially if it needs to ever raise outside capital. So what is the role of and the necessity for these public accounting firms, CPAs? Why do companies need to incur the great expense of having their financial statements audited? Well, in the corporate realm, right, there's a separation of ownership and control. Shareholders are principals who, through a board of directors, technically hire managers as their agents to manage the shareholders' interests in the company. An agent is hired by a principal to act on the principal's behalf in some way, and is generally required to act in the principal's best interest, to put the principal's economic interest above that of the agent themselves. In a perfect world, with purely benevolent agents, that would not be a problem. But agents are imperfect humans. And that gives rise to what we call the agent-principal conflict, or agency theory in economics. The agent's, management's, risks and preferences and their incentives will most likely differ from that of the principal, the shareholders. So they are potentially driven to make decisions that are contrary to the principal's interests. Owners and shareholders can observe every action and decision taken by management. Corporate management in particular has incentives, generally, to provide the most positive picture of results, as that will likely lead to higher compensation for them. Owners may even want to stretch the truth at times to make the firm look more attractive to lenders or possible acquirers. The end result is a need for reports to be verified by an independent third party, and that's what incurs what are known as agency costs. Interestingly, to me at least, I'm a bit of a nerd about this stuff, this process first developed in the U.S. in the colonial period. At that time, the U.S. was the emerging economy without much capital of its own. So an entrepreneur in the U.S. with a business idea would have to go back to Britain or to France to try to raise capital for new businesses. If the European investors decided to fund the entrepreneur's request, they had very little way to confirm what the entrepreneur would actually and ultimately do with the funds. So, shortly after the entrepreneur headed back to America, the investor would have to hire someone to be on the next ship to America and check up on the entrepreneur. That became very expensive. So, the practice of hiring independent auditors arose. Those auditors would produce financial statements and verify that they were truthful, accurate, and fairly represented what the business was doing with the investor's money. Because these auditors were local to the market, they could significantly cut the costs of verifying these business results for the ultimate investor.